Welcome to the Deep Dive. Today we're tackling something really crucial in the financial world. How big banks figure out um, how much money they need to keep in reserve, to cover potential loan losses.
Exactly.
We're diving deep into the internal ratings-based, or IRB, approach.
Mm-hmm.
Think of this as understanding the sophisticated rule book that some of the biggest players use to keep the financial system safe.
That's right. We'll be looking at the guidelines from the Basel Committee on Banking Supervision, that's the big international body, and also our own OSFI, the Office of the Superintendent of Financial Institutions,
Right.
to see how Canadian banks, the ones with OSFIs, use their own internal smarts, if you like, to calculate their capital cushions.
Their own weather forecasting, almost.
Yeah, it's like they're using their own weather forecasting to prepare for potential storms in the lending market.
Okay, let's unpack this internal smarts idea. So instead of everyone using the same yardstick, banks with IRB approval get to use their own risk assessments. We're talking about their predictions for things like the probability of default. So, how likely is a borrower to not pay back?
PD, yeah.
And the loss given default, if they do default, how much might the bank actually lose?
LGD, got it.
Their exposure at default EAD, how much money might be owed when things go south, and the effective maturity of their exposures.
Yeah.
It sounds like they get a fair bit of control.
They do, but always with oversight. They provide their own estimates for these key risk bits, but sometimes OSFI will, step in.
Set some floors or specific values.
Exactly. Set supervisory values just to ensure a baseline level of prudence.
Yeah.
This whole approach, it kind of rests on two main ideas.
Okay.
First, there's unexpected loss UL. This is the big one that determines how much capital they actually need to hold.
Right, the buffer.
And then there's expected loss, EL. That's handled differently, more through allowances and provisions.
So like budgeting for the normal course of business losses.
Pretty much. Think of EL as budgeting for the losses they sort of anticipate will happen.
Yeah.
So unexpected loss is the capital buffer against the really nasty surprises.
Interesting. So what kinds of loans and financial deals are we actually talking about here? Which ones fall under IRB?
It covers a pretty broad spectrum. We're looking at corporate lending, and that includes some really interesting specialized types we should dig into later.
Okay.
Also sovereign debt, so government bonds and loans, exposures to public sector organizations, loans to other banks, and retail lending.
Retail, like mortgages, credit cards.
Exactly. Your mortgages, your credit cards, car loans, that sort of thing.
Yeah.
One important point, though. IRB is not permitted for equity investments.
Got it. No stocks under this approach. So before a bank can even start using its own risk numbers, they need to properly sort all their loans and other commitments into these specific categories, right?
Absolutely. It's like organizing your tools before you start a big job.
Yeah.
Institutions have to categorize everything in their banking book based on the fundamental risk characteristics. Even if their internal systems use slightly different labels, maybe for their own management purposes.
Mm-hmm.
For calculating capital, they absolutely have to align with these specific regulatory categories. And OSFI has to approve their method for doing this.
To make sure they're not, gaming the system.
Precisely. Ensuring they're not shifting things around just to make their capital look better than it really is.
Okay, let's get into the nitty-gritty of some of these categories then. What exactly counts as a corporate exposure?
Generally, a corporate exposure is, well, any loan or other form of credit given to a business. Could be a huge multinational, could be a small local shop.
Partnerships, too.
Yep, partnerships. Even those special purpose entities, SPEs, you hear about sometimes. Those are usually set up for a specific project or maybe to hold certain assets.
Right.
And what's interesting is banks can also choose to break out their lending to small and medium-sized enterprises, SMEs, as a distinct group within corporate.
Okay. And you mentioned specialized lending tucked inside that corporate bucket. That sounds like it might have its own unique risks. What makes lending specialized?
Yes, specialized lending, or SL, it has distinct characteristics, either in how it's legally structured or just in its underlying economics.
Okay.
Typically, it includes things like project finance, lending against income-producing real estate, financing for specific big-ticket items like airplanes or ships.
Like asset finance.
Exactly. Commodities finance, and also something called high volatility commercial real estate.
High volatility commercial real estate, HVCRE. Just the name sounds like it could cause some headaches.
It definitely carries a, shall we say, greater potential for unpredictable losses compared to other types of specialized lending. The regulations actually outline three main ways something gets classified as HVCRE.
Okay, what are they?
One is commercial real estate in countries where the local regulators have already flagged the market as particularly volatile.
So piggybacking on local knowledge,
Right. Another is loans financing the acquisition, development, and construction, the ADC phase of properties in those same volatile places.
okay, so if it's already seen as a risky area elsewhere, it gets flagged here too. What about for properties here in Canada? Is there an HVCRE definition?
Yes. For Canadian properties, the HVCRE category mainly focuses on loans financing that initial ADC phase,
The building phase.
right, the building phase, where the repayment of the loan isn't really secure unless the borrower has put in a significant chunk of their own money, their own equity.
Oh, significant.
Significant here is defined as at least 25% of the appraised value of the property once it's completed. That has to come from the borrower.
Ah, so they need real skin in the game.
Exactly. It's all about ensuring they have substantial skin in the game. If they stand to lose a big chunk of their own cash, they're probably more motivated to see the project succeed.
Makes sense. You also mentioned project finance earlier as a key type of specialized lending. What's the main thing that sets that apart?
Okay, with project finance, the lender is primarily looking at the cash flow generated by one specific project for repayment.
Just that single project.
Yes, and the project's assets themselves are usually the main security for the loan. Think about those really big, complex undertakings, like a new power plant, maybe a major infrastructure project like a toll road or a large mining operation.
Huge projects.
Huge. And the entity borrowing the money is often one of those special purpose entities created just for that project. So the bank's ability to get repaid is very, very closely tied to the financial success of that one project.
Which is different from lending to a big diversified company.
Absolutely. Different from a typical loan to a well-established company with lots of different operations. The key insight here is that the bank's fate is uniquely tied to that single project's success, so it demands a different kind of risk lens than your standard corporate loan.
Right, the project really has to stand on its own 2 feet financially. Now let's switch gears slightly to those commitments we sometimes hear about, like when a bank promises to lend someone money down the road. How are those handled?
Good question. Commitments, which are basically agreements to extend credit or maybe purchase assets or issue guarantees later on, they're also taken into account under IRB.
Okay.
There are specific ways of treating commitments that the bank can cancel unconditionally, or maybe ones they can cancel if the borrower doesn't meet certain agreed-upon conditions, like maintaining a certain financial ratio.
Even undrawn amounts?
Yes, even unfunded mortgage commitments, for instance. Once the borrower has accepted and all the conditions are met, those are factored into the capital calculations too.
So it's like reserving capital for potential future lending they've promised.
That's a good way to think about it, reserving for those potential future draws.
Okay, so we've got these different types of exposures, these categories. Now, I remember you mentioned 2 main ways banks can use the IRB approach, foundation and advanced. What's the core difference?
Yeah, for the big categories like corporate, sovereign, public sector entity, and bank exposures, the main difference boils down to who gets to estimate those key risk components we talked about. PD, LGD, EAD, and M.
Right.
Under the foundation IRB, or FIRB, the bank provides its own estimates for the probability of default, the PD.
Okay, they do that part.
They do that. And they also calculate the effective maturity, M. However, and this is the key difference for the loss given default, LGD, and the exposure at default, EAD. They have to use estimates set by the regulators, supervisory values.
So they get some flexibility on predicting the likelihood of default, but not on the consequences.
That's a good way to put it. They get flexibility on PD, but the regulators provide sort of safety net of assumptions for LGD and EAD, which can be trickier to estimate consistently.
So foundation is like getting to do some of the homework yourself, but maybe using the teacher's answer key for the tougher questions.
Yeah, something like that.
And what about the advanced IRB or AIRB? What's different there?
Well, with the advanced approach, banks that meet, frankly, more rigorous requirements.
Higher standards.
Much higher standards, yes. They get to develop and use their own internal models to estimate all 4 of those key risk components, PD, LGD, EAD, and they calculate M.
Ah, so they get to use their own numbers across the board.
Pretty much.
Yeah.
But it means a big step up in terms of how sophisticated their risk management needs to be and the sheer amount of data they need to back up their estimates.
So the key takeaway is really about sophistication. The more advanced your risk systems, the more you get to rely on your own internal views.
Exactly. But always within OSFI's framework and subject to their approval and ongoing review, of course.
Got it. Foundation is kind of a stepping stone towards advanced. Now let's dig a bit deeper into these risk components themselves. Probability of default, PD. How do banks even begin to figure that out? It sounds a bit like gazing into a crystal ball.
It does involve looking ahead, yeah, but it's meant to be grounded in historical data and statistical analysis. Banks need to estimate the likelihood that a borrower will fail to meet their payments over the next year.
Based on what? Past behavior?
That's a big part of it.
Yeah.
Looking at their past repayment history, maybe comparing their internal risk ratings to ratings from external agencies like Moody's or S&P, or using statistical models that analyze various financial indicators, debt levels, profitability, things like that.
Okay.
There are also specific things they need to consider for borrowers who are, say, highly leveraged or whose assets are mainly traded on the market. That requires them to think about how volatile market conditions might impact their ability to repay. Stress testing, essentially.
Right.
And the crucial point here is that banks have to be pretty cautious when using any forward-looking information. And they need to be very aware of any limitations in the data they're using.
Conservative is the watchword, it sounds like.
Conservative is definitely the watchword in this game. Always.
Okay. What about loss given default, or LGD? What exactly are we measuring there?
LGD is the percentage of the exposure the bank expects to lose if a borrower actually defaults.
Yeah.
So not if they default, but how much is lost when they do.
Right.
Under the Foundation approach, FIRB, the regulators provide standard LGD figures, usually 40% for most senior unsecured corporate loans,
Okay, 40%.
45% for other types of retail loans, and a much higher 75% for any loans that are in a junior or subordinated position, because you're further back in the queue if things go wrong.
Makes sense.
However, even under FIRB, banks can get some credit for having good collateral, what's called eligible IRB collateral.
Counts as eligible.
This includes things like accounts receivable, certain types of commercial and residential real estate with specific conditions, of course, and other forms of security beyond just standard financial collateral like cash or bonds.
So having good security can lower that assumed loss number, even in Foundation.
Exactly. Having good collateral acts as a buffer, potentially reducing that assumed loss percentage in case of default.
And how does LGD work under the advanced IRB? Is it just whatever the bank's model says?
Well, under ARB, banks use their own internal models, yes. They estimate LGD based on their own historical loss experience and their expectations going forward.
But are there limits?
Oh, yes. These internal estimates aren't completely free range. They have to meet certain minimum standards, and crucially, there are lower limits or floors on the LGD they can use, even for loans secured by collateral.
Why the floors?
It's essentially to prevent banks from being overly optimistic in their loss estimates, especially during good economic times when maybe losses have been low historically. It ensures a minimum level of prudence.
Got it. What happens when a loan has a guarantor? If someone else promises to pay if the original borrower can't. How does that factor in?
Good point. Both FIRB and AIRB have rules for recognizing eligible guarantees. Under FIRB, for the part of the loan that's guaranteed, you essentially substitute the risk profile, specifically the probability default of the guarantor, for that of the original borrower.
You look at the guarantor's riskiness.
Exactly. And the assumed loss, if the guarantor were to default, their LGD, can also be factored in, potentially lowering the overall risk weight.
And under advanced?
Under AIRB, banks have a bit more flexibility. They can reflect the lower risk from an eligible guarantee by either adjusting their estimate of the borrower's PD downwards or by adjusting their estimate of the LGD downwards.
But not both.
Right. Importantly, in both FIRB and AIRB, you can't get a double benefit. The calculated risk weight can't end up being lower than if the bank had just lent directly to the guarantor in the first place. There's a floor based on the guarantor's own risk.
Makes sense. You don't get to count the risk reduction twice. Okay, let's move to exposure at default, or EAD. What does that tell us?
EAD is the total amount that the borrower is expected to owe the bank right at the point they default.
So for a simple loan, it's just the outstanding balance.
Usually, yes. For loans where the money has already been fully drawn, it's typically just the current outstanding balance. But for things like lines of credit or other off-balance sheet commitments where the borrower hasn't used the full amount yet.
Like a credit card limit.
Exactly, like a credit card limit. It's potential future borrowing. For those, banks use what are called credit conversion factors, or CCFs.
Okay, CCFs. What do they do?
CCFs are like percentages that banks apply to the undrawn amount to estimate how much of that potential credit line might actually be drawn down by the borrower as they get into financial trouble right before they default.
Ah, people might max out their cards when things get tough.
That's the idea. Under ARB, banks develop their own EAD estimates and their own CCFs,
Sure.
taking into account this possibility that borrowers might draw down more of their available credit as they approach default.
But again, I'm guessing there are floors.
You guessed it. Just like with LGD, there's a regulatory floor on how low those EAD estimates, including the effective CCFs, can go. Again, conservatism.
Okay. And finally, in this group, we have effective maturity, or M. Is that simply how long the loan is for, like the term?
Not quite. It's related to the lifespan of the exposure, obviously, but it's a specific calculation that tries to capture the time horizon of the risk more accurately than just the stated final maturity.
How so?
Well, think about it. If a loan has a single bullet repayment at the very end, all the risk is concentrated later on. If it amortizes smoothly, the risk reduces over time. M tries to reflect these kinds of differences in the timing of cash flows and risk.
I see.
However, the regulations do provide a standard default value of 2.5 years for M that banks can use for many exposures, unless there are more specific rules for certain types of loans, like short-term ones.
Okay, so 2.5 years is a common benchmark unless specified otherwise. It's a bit more complex than just the loan term on the contract.
A little bit, yeah. It's meant to better capture the economic substance of the timing of the risk.
Okay. Now, you mentioned earlier that if a bank can't quite meet the requirements for estimating PD for their corporate loans under the standard IRB approach,
Right.
they have to use something called the supervisory slotting approach, specifically for specialized lending. What's that all about?
That's right. This is a more standardized, kind of less model-driven way of assessing risk, but only for those specialized lending categories we discussed, project finance, HVCRE, etc.
Okay.
Instead of relying on their own PD estimates, banks have to categorize or slot their specialized lending exposures into one of 5 predefined risk categories set by the regulators.
And what are these slots?
They are strong, good, satisfactory, weak, and default. Pretty intuitive labels.
Yeah.
Each of these categories, or slots, has a specific fixed risk weight associated with it. And
Right.
importantly, for high volatility commercial real estate, those risk weights are even higher within each category to reflect that inherently increased risk.
So higher capital for HV across the board.
Yes. And there are also corresponding expected loss, EL, risk weights that go along with these categories used for calculating provisions. So it's much less about the bank's individual assessment and more about fitting the loan into these predefined regulatory buckets based on certain criteria.
A more structured, less flexible approach for SL, with these distinct categories reflecting increasing levels of regulatory concern.
Got it. What about when a bank buys a portfolio of loans or receivables from someone else? How does IRB handle purchased receivables?
Right. If a bank purchases receivables like a portfolio of credit card balances or auto loans, and they meet certain quality standards set out in the rules,
Uh-huh.
then the amount of capital they need to hold against them is based on the same risk weighting rules that would apply if they had originated those loans themselves. Assuming, of course, the receivables clearly fall into one of the standard IRB asset classes.
So you treat them like your own originations if they're similar enough. Basically, yes, provided they meet the standards. However, if they buy a mixed bag, a hybrid pool with different types of receivables, different risk characteristics, and they can't easily separate them out for risk assessment,
Then what?
then they have to apply the risk weighting rule that results in the highest capital requirement for any of the types of exposures included in that pool.
Ouch. So the riskiest part drives the capital for the whole pool.
Pretty much. It incentivizes banks to have clarity on the risk profile of the assets they purchase. You really need to do your homework before buying a big chunk of loans.
Sounds like it. Now, just having a good risk model isn't enough to use the IRB approach, is it? There must be a whole host of other things banks need to have in place, like governance and controls.
Oh, absolutely. Having the models is just one piece. The regulatory framework sets out very detailed minimum requirements that banks have to meet, both to get approved for IRB initially and to continue using it.
Right.
These cover pretty much every aspect of their risk management. How they design and operate their internal rating systems, their corporate governance structures, how they actually quantify risk day to day, and crucially, how they validate the accuracy of their own estimates over time.
Let's touch on some of the key aspects there. What exactly goes into the rating system design? That sounds quite foundational.
It really is. A rating system isn't just a model. It's the whole framework a bank uses to assess creditworthiness. It includes all the methods, the processes, the controls, the data they collect, and the IT systems they use.
The whole infrastructure.
The whole infrastructure that helps them assign internal risk ratings and estimate PD, LGD, and EAD. Banks can have different rating systems for different types of borrowers or products within each broad asset class, like corporate or retail.
But they need a reason.
Yes, they need a clear rationale for assigning a borrower or facility to a specific system.
Yeah.
And they absolutely cannot selectively choose systems just to minimize their capital requirements. That's what regulators mean by prohibiting cherry picking. These systems need to consider a really wide range of factors about both the borrower and the specific loan or transaction. Things like the type of borrower, their industry, maybe demographics for retail, the product type, any collateral or guarantees involved, the seniority of the claim, and of course, any history of payment problems or delinquency.
Okay. And how many different rating grades do they typically need? It can't just be good risk or bad risk, sure.
No, definitely not. They need to have a sufficient number of rating grades to avoid having too many borrowers or loans lumped into just a few broad categories.
To allow for finer distinctions.
Exactly. It ensures they can achieve meaningful risk differentiation. For instance, for banks using that supervisory slotting approach for specialized lending we talked about, there's a minimum of 4 rating grades, just for borrowers who aren't currently in default.
Wow, okay.
The definitions for each of these rating grades have to be very specific. They need to be plausible, make intuitive sense, and crucially, be applied consistently across the entire institution and based on all relevant current information.
That sounds like a massive undertaking to ensure consistency across a large bank.
It is. It requires clear documentation, training, and ongoing oversight.
And what about when banks use statistical models as part of this? You mentioned models earlier. Are they just letting the computer decide everything?
No, not at all. That's a key point. While statistical models can be, and often are, a valuable tool in the rating process and in estimating PD, LGD, and EAD, there absolutely needs to be significant human judgment and oversight involved.
Why is that?
Well, to make sure that all relevant factors are considered, especially qualitative ones that might not be easily captured by a quantitative model, and also to ensure the model is being used appropriately for this specific situation. Human oversight acts as a check.
Okay.
Banks have to demonstrate that their models are actually good at predicting defaults and losses, that they have predictive power. They need to show they use sensible factors in their calculations, that they're generally accurate over time, and that they are built using data that truly represents their actual borrowers and loan book.
And they can't just build a model and leave it.
Definitely not.
Yeah.
Crucially, these models need to be regularly checked, monitored, and validated independently to make sure they are still performing as expected as conditions change. So it's very much a combination of sophisticated analysis and experienced human insight, not just algorithms running loose.
Got it. So models plus judgment. What else is really critical for meeting these minimum requirements? You mentioned governance.
Yes, strong corporate governance and oversight from senior management are absolutely essential. The people right at the top need to understand and approve all the important aspects of the rating and estimation processes.
They need to be bought in.
Completely. They need to regularly discuss how well these processes are working with the bank's credit risk control function, which needs to be independent from the business lines, by the way.
Independence is key.
Critical.
Yeah.
And senior management needs to receive regular reports on the bank's overall risk profile, the performance of the models, and the key risk parameter estimates. There also needs to be regular internal audits of the entire IRB system. It's about checks and balances.
And these internal ratings and risk estimates, PD, LGD, EAD, they can't just be something the bank calculates for OSFI reports, right? They have to actually use them.
Exactly. That's a fundamental requirement. The internal ratings and the estimates of default and loss must be a core, integral part of how the bank operates day to day.
How so?
They have to be used in making decisions about credit approval. Should we grant this loan? How should we price it? They need to be used in managing risks across the portfolio and deciding how to allocate capital internally between different business units and generally in the bank's corporate governance and reporting.
So they can't just be for show.
Absolutely not. They can't just be produced solely for the purpose of regulatory capital calculations. Furthermore, banks need to demonstrate that they've been using a rating system that largely meets these minimum requirements for at least 3 years before they can even be approved to use the IRB approach.
3 years, wow.
Yeah, the use test and the track record requirement. It really emphasizes that adopting IRB is meant to be a fundamental shift in how the bank manages risk, not just some technical compliance exercise you bolt on at the end.
That shows it's not something you can just implement overnight. Now, when it comes to actually putting numbers on the risk quantification part, estimating PD, LGD, EAD, what are some key things banks need to think about there?
Well, they need to have robust methods, as we've said. These methods should ideally look at their long-run experience, using data that spans different economic conditions if possible. They should use a variety of data sources. Internal data is key, but external data can supplement it.
Okay.
And they also need to have a very clear, objective, and consistent definition of what constitutes a default across the institution.
What usually counts as a default?
The standard reference definition includes several triggers. Things like putting a loan on non-accrual status, meaning the bank no longer expects to receive the contractual interest payments,
Right.
writing off or making a specific provision against a loan because its credit quality has significantly deteriorated, selling the loan at a substantial credit-related economic loss, or the borrower filing for bankruptcy or similar protection.
Pretty clear signals of distress.
Yes. And for retail loans, the definition can often be applied at the level of the individual loan or facility. There's also often a days past due element, like being 90 days overdue on a significant payment. For certain types of revolving credit, like credit cards qualifying revolving retail exposures or QRE, there's sometimes a slightly longer past due threshold allowed, maybe 180 days.
Okay. And when they're estimating OGD, the loss given default.
It's really important that their LGD estimates reflect the expected economic loss, not just the accounting loss or charge-off amount.
What's the difference?
Economic loss includes things like the discounting effect getting money back later is worth less than getting it now. It also includes all the direct and indirect costs associated with collecting on the defaulted loan. So it aims to be a more comprehensive measure of the actual financial hit.
Got it. And after all these complex estimates are made, they just get used, right? It's sort of a one-and-done process each quarter.
Oh, definitely not. There's a really critical ongoing step: validation.
Validation.
Yes. Banks need to have a strong, independent system in place to regularly validate the accuracy and consistency of their rating systems and their risk component estimates. This means comparing their actual realized default rates over time with the PD estimates their models produced for those same borrowers beforehand.
Seeing how well they predicted things.
Exactly. And for those banks using the advanced IRB approach, they need to do the same kind of back testing for their LGD and EAD estimates, comparing estimated losses and exposures to what actually happened after default.
How far back do they look?
They need to look at historical data over as long a period as possible, covering different economic conditions. They use various statistical tools and also compare their internal results with any relevant external data or benchmarks. The whole point is continuous monitoring and improvement.
So it's a constant cycle.
Yeah.
Estimate, apply, measure the results, then check and refine the estimates.
Precisely. Rigorous checking to see if those estimates were on the mark and adjusting the models or processes if they weren't. It's fundamental to maintaining trust in the internal ratings.
Okay. What about when a bank uses things like collateral, a house backing a mortgage, for example, or guarantees to reduce their credit risk? How are those credit risk mitigants, or CRMs, recognized under IRB?
Yeah, that's important. There are very specific requirements for recognizing different types of CRMs to ensure they actually provide the risk reduction the bank is claiming. For collateral, this includes making sure the legal agreement giving the bank rights over the collateral is solid and enforceable in bankruptcy, having proper documentation, valuing the collateral at its fair market value, and updating that valuation regularly. Frequency depends on the type of collateral and its volatility.
Can't use an old valuation.
No. And having good operational procedures for managing the collateral, like insurance and monitoring. For real estate used as collateral under the Foundation IRB approach, the bank usually needs to have the first claim, the first lien on the property.
Yeah, usually first lien. Okay.
There are exceptions, like if the bank also holds the senior lien, but first lien is the general rule for FIRB real estate collateral. There are also specific rules for what types of financial assets, cash, bonds, equities, sometimes count as eligible financial collateral, which often gets more favorable treatment, and rules for recognizing receivables as collateral too.
And for guarantees?
For guarantees to be eligible, the guarantor themselves generally has to be of a certain minimum creditworthiness. The guarantee must be in writing, legally binding, explicit about the amount covered, and generally unconditional and non-cancelable by the guarantor.
Solid guarantees only.
Pretty much. There are also restrictions on recognizing guarantees from related parties within the same corporate group, like a parent company guaranteeing a subsidiary's debt, although there might be exceptions for specific things like short-term trade finance.
Okay.
Similar detailed principles apply to recognizing credit derivatives, like credit default swaps, as risk mitigants. You need to ensure it covers the right underlying asset, consider the payout structure, potential basis risk, etc. So yeah, a lot of detail around ensuring these risk reducers are actually effective and legally sound before you get capital relief for them.
It's definitely not just a handshake agreement that counts. What about leasing? How are those kinds of exposures treated under IRB? Are they just loans secured by the leased asset?
Leases are typically treated in one of two main ways. They can be treated essentially as loans that are secured by the leased asset itself. Think of financing for a piece of equipment where the equipment is the collateral.
Okay.
In that case, the same minimum requirements for recognizing that type of physical collateral would apply. Robust risk management of the asset, strong legal framework, etc.
And the other way?
The other way is recognizing that some leases expose the bank not just to the borrower's credit risk, but also to residual value risk.
Residual value risk.
Yeah, the risk that the asset itself, the car, the plane, whatever it is, will be worth less than the bank expected at the end of the lease term when they get it back.
The resale value risk.
Exactly. For that part of the exposure that represents the residual value risk, it's typically assigned a flat risk weight of 100%. So you separate the credit risk part from the asset value risk part.
Interesting distinction. And finally, on these minimum requirements, to even be allowed to use the IRB approach in the first place, banks have to be transparent about what they're doing, right? It can't all be a secret internal formula.
Absolutely right. Institutions must meet OSFI's Pillar 3 disclosure requirements to be eligible for and to continue using the IRB approach.
Pillar 3, that's the public disclosure pillar of Basel.
That's the one. It means they need to publicly report quite detailed information about their risk assessment methods, their key risk parameter estimates, like average PDs and LGDs by portfolio, their capital adequacy calculations, and how they manage their risks overall.
So investors and the public can get a sense of their risk profile.
Exactly. It helps ensure market discipline and provides a level of transparency into how these sophisticated banks are calculating their capital needs under the IRB framework.
Okay. Now, you mentioned earlier a really specific example related to residential mortgages, this idea of minimum price correction or a downside LGD floor, DLGD floor. This sounds quite targeted. What's the thinking behind that?
Yeah, the downside LGD floor is an interesting, quite specific overlay. It's an extra capital requirement, essentially a floor on the loss given default estimate that applies specifically to insured residential mortgages.
Only insured ones.
Yes, insured residential mortgages located in certain major Canadian metropolitan areas, but only when house prices in those specific areas experience significant declines.
So it's a localized stress adjustment for insured mortgages.
Exactly. It's OSI's way to make sure banks hold enough capital to absorb potentially higher losses on even insured mortgages if a local housing market corrects sharply. Because even insurance might not cover everything in a severe downturn scenario.
Right, there could still be losses or delays. So this incredibly specific calculation is all about making sure banks hold enough capital, even if housing prices take a significant nosedive in certain, maybe more vulnerable cities.
That's the idea behind it. Targeted prudence.
And how do they actually determine if house prices have fallen enough in a specific city to trigger this extra requirement? It sounds like they need a pretty precise measure.
They do. They use publicly available data, primarily from the Teranet National Bank House Price Index, TM.
The Teranet Index, yeah.
Right, and also some data from Statistics Canada on income. They calculate something called the Security Correction Indicator, or SCRI, for 11 specific major urban areas across Canada.
11 specific cities?
Yes, places like Toronto, Vancouver, Calgary, Montreal, etc. This SCRI calculation uses smoothed values from the Teranet Index over time, related to per capita income figures, and then it's adjusted by a specific scaling factor that OSFI determined for each of those 11 cities.
Okay, so a city-specific indicator based on house prices and income, then what?
Then OSFI sets specific trigger levels or thresholds for the SQRI value in each of those 11 areas.
Okay, so if this SQRI number goes above a certain level for, say, Calgary.
Exactly. If the calculated SQRI for a metropolitan area exceeds OSFI's threshold for that area, then a minimum house price correction of 25% is automatically applied when calculating the downside LGD floor for insured mortgages located in that city.
A 25% assumed drop.
Yes, a 25% minimum price correction, which they call a LUNP, delta P, is plugged into the DLGD formula for the following 3-month regulatory reporting period. This CARP itself is calculated based on how much the current house price index for that city has fallen from a previous peak, but it's floored at 25% once the SQRI threshold is breached.
So it's a way of saying, okay, house prices have dropped significantly here according to our indicator, so we need to assume at least a 25% further drop from the peak when calculating potential losses on insured mortgages in this area, just to be safe.
Precisely. The DLGD floor is then calculated using a formula that incorporates the current loan-to-value, CLTV, of the mortgage and this price correction factor.
Banks have to tell OSFI when this happens.
Yes, they have to inform OSFI when these trigger levels are initially breached for any city, and also when the SQRI subsequently falls back below the threshold and the minimum correction no longer applies. It's a very specific, dynamic, and localized capital requirement adjustment. Highlights just how granular these regulations can get.
It really does. And you mentioned we have an example.
Yes, the guideline provides one. For Calgary, back in the third quarter of 2016 reporting period, they calculated the SCRI based on the house price data from February 2016 and the income data from the end of 2015.
And what was the result?
The SCRI for Calgary came out at 11.92, since OSFI's threshold for Calgary was set at 10.0.
It breached the threshold.
It did. So that would have triggered the 25% minimum price correction being applied to the DLGD floor calculation for insured mortgages in Calgary for that Q3 2016 reporting.
That's a really clear illustration of how this mechanism works in practice. Shows how these indicators directly translate into potential extra capital requirements in specific circumstances. Well, this has truly been a deep dive into the IRB approach. It's remarkable just how complex and rigorous these requirements really are.
It is indeed. It's a very detailed framework. But the whole point of this sophistication is to allow the largest, most complex financial institutions to tailor their capital requirements more closely to their own specific assessments of risk.
Using their own data and models.
Right. But while doing so within a very robust set of regulatory standards and minimums set by international bodies like the BCBS and enforced domestically by OSFI, it aims for risk sensitivity, but with strong guardrails.
And it's not a static set of rules either, is it? You mentioned validation, monitoring. It seems like it's constantly evolving.
It has to be. These requirements are constantly being monitored by the banks, reviewed by OSFI, and sometimes adapted or clarified as the financial landscape, modeling techniques, or risks themselves evolve.
So it's an ongoing process of refinement and oversight, really, trying to ensure the system stays resilient.
Precisely. That's the goal.
Well, this deep dive has certainly given us, and hopefully you listening, a fascinating glimpse into the intricate world of banking regulation and risk management. It really makes you think about the bigger picture, doesn't it? Like, how might these complex internal risk assessments and the capital levels they ultimately dictate influence the actual availability and the cost of credit for everyday individuals and businesses?
That's a great question. The downstream effects.
Yeah. And what are some of the broader economic implications of having this kind of regulatory framework designed to keep our financial system stable? Does it make things safer but maybe less dynamic? Some really important questions to consider.
Definitely food for thought.
If you're interested in learning even more, and there's always more, we definitely encourage you to explore the resources available directly from the Basel Committee on Banking Supervision and from OSFI for a truly comprehensive understanding.
The source documents are the place to go for the full detail.
Absolutely. Thanks for joining us on the Deep Dive.